morning people. So in the today's session we'll be taking up RTP January 2025 of Advanced Accounting. Alright. Yes, I'm not feeling that well, little feverish. So I'll try to complete this RTP if in the today's session only if my body permits. Otherwise I may have to take a break. Okay. I'll try my best to finish this. Okay sir? Alright. Excuse me. Alright. Now, yes, so overall if I have to talk about this RTP ka standard, 2 or 3 questions you could say has been newly formed, okay, using new concepts. Rest everything is pretty much the same. So whatever concept we have learned, most of the questions are around that itself. So in this particular RTP, we'll be taking up the new questions. What and all new questions have been added up, only that we will be covering. If it is repetitive or if it belongs to the same concept, we will not be doing that in this particular session, okay. Alright, so we'll get started with question number 1. A couple of them are MCQ questions based on case-based MCQs basically. So this is based on Accounting Standard 28. AS 28 is on impairment. Surya Limited has 2 fixed asset. They're calling it as FA1 and second fixed asset they're calling it as FA2. FA1 ka carrying amount is 600, FA2 ka is 300. On 31st March 20x4, value in use for FA1 is 500. Net selling price is 550. Sir, in fact, as I told you, before you dive into the case study, always read the requirement. That way you will get to know what information we need to pick from the case. So if you just check, first they've asked what is the total impairment loss for which asset? FA1. Then they asked how much impairment loss will be going off to P&L account. Then they asked how much is the impairment loss for FA2 and what is the carrying amount of FA1 after impairment loss. So that means it's a simple question. Sir, to get impairment loss will only get triggered under one scenario. What is that one scenario? If carrying amount, if it is greater than recoverable amount, only then impairment loss will come. And how do you get recoverable amount? Recoverable amount is higher of 2 things, value in use and net selling price, whichever is higher. So let's punch in the data. FA1, what is the carrying amount given? 600 and FA2 it is 300. Carrying amount given are plugged in. Next, value in use they have given. How much for FA1? 500. NSP is how much? 550 are plugged in this. Done. Now how do you get recoverable amount? Value in use or NSP, whichever is higher. Which is higher of the two? 550. So that means recoverable amount is 550. Carrying amount is 600 for FA1. Recoverable amount is only 550. You are showing the asset at 600 but you can recover only 550. So is FA1 the first fixed asset impaired? Yes. By how much? These two come minus if you do, you will get how much impairment loss? 50. Any problem? No. Let's do a similar exercise for FA2. What is value in use for FA2? 350. What is NSP? 320. I've updated both. So how do you get recoverable amount? Higher of 2 things, 350 or 320, whichever is higher. Which is higher? 350. So recoverable amount of FA2 is 350. Carrying amount is only 300. You are showing the asset in your books at 300, but by using or by selling you can recover how much? 350. So this particular asset, is it impaired? No. So second asset ka impairment loss is 0. So far okay? Now, where will impairment loss normally go to, sir? Normally impairment loss like depreciation you transfer it to P&L account. Under every circumstance? No. First you will check if this particular asset was revalued and do we have any revaluation reserve relating to which asset? FA1. If you have any balance and revaluation reserve, that means first impairment loss will be adjusted with RR. Correct? Revaluation reserve. Balance impairment loss only will go off to P&L account. All this we have learned. Check. Have they told any information? The company did an upward revaluation for 20 lakh rupees for FA1. That means FA1 does it have RR? RR as in revaluation reserve. How much is it? 20 lakh. That means is FA1 impaired? Yes. By how much? 50. Entire 50 will you transfer it to P&L? No. Of this 50, how much will you adjust with RR? 20 lakh. Balance 30 lakh only impairment loss you will transfer it off to P&L account. Done, people? So that is what with respect to FA1. Done? Now after you book the impairment loss, carrying amount will be same or it will get revised? Revised. What is the carrying amount before impairment loss? 600. How much impairment loss you charged? 50. So that means the revised carrying amount will be what? 600 minus 50. So the revised carrying amount will become 550. That 550 is nothing but your recoverable amount. Yes, sir, people? All this they have asked. For FA2, is there any impairment loss? No. That means the revised carrying amount also will be how much? 300. Okay. Done, people? In fact, for your reference, I can also write what is the journal entry for this impairment loss, sir? Only for your reference. What is the journal entry for impairment loss? Impairment loss account debit 50 lakhs. I think all the numbers are in lakhs. To PP, which PP is that? FA1, which is what? 50 lakhs. And this impairment loss, will you transfer it to P&L? No. First you will transfer where? RR. RR, how much will you adjust? 20 lakhs. Then for P&L, how much will you transfer? The balance, 30 lakhs. To what? To impairment loss, 50 lakhs. This is the entry, not the vast, just for your reference, we did this. Now let's go for the requirement. What did they ask? What is the total impairment loss for FA1? What is the total impairment loss for FA1, sir? 50. Which option has that? D for Bengaluru. How much impairment loss will be charged to P&L account relating to FA1? Was FA1 impaired? Yes, it was impaired by 50, but the entire 50 went to P&L account? No. How much went to P&L account? Only 30. Yes. Which option has 30 lakhs? C. The third option is the right one over there. Correct, people? Alright, moving along. How much is the impairment loss for FA2? Is FA2 impaired? No. FA2 ka impairment loss is 0. So that means which option has 0? Fourth one. Last one. What is the carrying amount on 1st April 2024? Sir, our first year ends on 31st March 2024. Now they are asking next year ka opening balance. This year ka closing balance will become next year ka opening balance. Of which opening balance they are asking? Carrying amount of 1st April 2024 of FA1. After impairment loss, carrying amount will get revised for FA1. How much is it? 550. This is the carrying amount on which date? On 31st March 2024. This only becomes next year ka opening balance. So what is the carrying amount of FA1? 550. Which option has 550? A. That's all is this particular question all about. Easy. Any problem or all okay? Comfortable? Okay, moving along. It's a general MCQ. Debit or credit balance in foreign currency monetary item translation difference. We used to call this as FCMITD if you remember. There's another name, FCMITR. Foreign currency monetary item translation reserve. Where will you show this FCMITD or FCMITR is what they're asking. What does FCMITR mean? R is what here? What is this R? Reserve. All reserve will come where? Under reserves and surplus. That means this should come under where? This FCMITD or also known as FCMITR should be shown under reserves and surplus. That's all. Is a simple question they asked. Nana people, doesn't matter what the balance is. Reserve, this reserve could have a debit balance or credit balance. It will always be shown under balance sheet under reserves and surplus only. You can't show it on the asset side. Okay, always under reserves and surplus. Any problem? Pretty straightforward. Then you have some normal question, descriptive question. This is a repetitive. Whatever is repetitive, I've denoted by the symbol R. Same question or similar question is already there in our class notes. That's the reason that we will not be doing. Yes, people? Okay, this is repetitive. AS3 ka is again repetitive. Okay, AS3 ka one point I'll tell you. They just asked classification. They'll give you various cash flows. You need to identify whether that particular transaction is operating cash flow, investing, financing or cash equivalent. Last part, tell me sir, what is marketable securities? Marketable security. We have a similar question in our class notes as well, but there one extra pointer was given. Here extra point is not given. Marketable security is what? Cash equivalent means what? They are highly liquid instruments whose maturity period is less than 3 months, and they should have their value should change frequently or it should not. It should not have significant value change risk. Yes, no? So this marketable security, they have not given any information, meaning whether its value will change frequently or not, or significantly or not. Data given or not given? Not given. So they have directly classified this to be cash equivalent. But you can also give a subjective answer, which is what? If there is a risk of change in value, if its value changes frequently or insignificantly, then will it be a cash equivalent? No. In that case, it will be what? Investing activity. But in this RTP, the answer is given to be cash equivalent because information is not available. I suggest if just marketable securities come in examination, you directly write cash equivalent. But in one of the problems we had done, they had given marketable security. In bracket, they had told it has significant value change risk. If it has significant value change risk, is it cash equivalent? No. There in our class notes, we had written not a cash equivalent, if you remember. That way, this adjustment is a little different. Rest everything is pretty straightforward. Need a minute to review or can I carry on? Okay. Online also okay, no people till now? Is my voice, these and all sounding fine? Here it's okay. Online also comfortable? Apologies, from the last 3-4 days I'm not feeling well. I can't. I thought initially I'll do the class next week, but next week I'm traveling, so I'll not have time. So that's the reason I thought, okay, I'll finish off and go only. Okay. So yeah. So the Josh from my side will be on the little lower side today. Okay. Alright. Now AS5 ka next question. During the course of the last 3 years, company, there's an AS5. AS5 we only talk about few things. No? What are those few things? Prior period item, accounting estimate, accounting policy change, etc. etc. So it's a question based on this. Marketable securities, point you want me to repeat. Sir, if they just say marketable securities, classify it as cash equivalent. That's what. Okay. If they say this marketable security ka value changes frequently, if it fluctuates, like let's say, okay, you purchased some debentures. You purchased some debentures. Usually debentures ka value will fluctuate frequently or not so much. Debenture is basically a stable instrument. That means if the maturity period of this debentures, if it is less than 3 months, means you will classify it as what? Cash equivalent. Suppose they tell you in the problem marketable security, and in bracket mein if they say value changes significantly, value will fluctuate too much. If value fluctuate too much means it is not cash equivalent, because one of the definition of cash equivalent is its value should not change significantly. Its value should be pretty much stable. That way. Okay. So if they just give this, classify it as cash equivalent. That's what I said. Comfortable? Can I move on? All this we have covered in our regular class, macha. Okay. If you just open the notes, you will be able to get it. Okay. Maybe a few things you have forgotten because it's been a while. Okay. But all the similar points, if you open cash flow statement and open the cash equivalent notes, I've given you some pointers for cash equivalent. There, if you go through, you will get it. All right. During the course of last 3 years, company owning and operating helicopters lost 4 helicopters. So this particular company is operating aeroplanes or helicopters. Maybe they use it for, even our big people now don't go in road. They always travel in air now. So maybe this company gives Ola Uber service, not through car, but through helicopter. But unfortunately, wrong was to this year for us. How many helicopters go in the 4? Crashed or whatever, we have lost 4 helicopters. Maybe how many we have, we don't know. Totally we have lost in the current year 4 helicopters. The company's accountant felt that after the crash, after this helicopter crashed, the accountant feels provision created in respect of respective helicopters will no longer be required and proposed to write back it to P&L account as a prior period item. Now normally we have studied this for your for your aeroplanes, ships, helicopters and all, you have to undergo periodic inspection charges, which we learned it as major inspection charges. In AS10 we studied this. Now this company, they have made some provision for inspection charges because it is probably required to be mandatorily done as per government rules. Maybe, we don't know. Now the accountant is saying that helicopter only is not there. So is provision required? No. So he is saying I will write back that provision. Okay, whatever provision is there, I will reverse and treat it as what? Prior period item. Okay, is this acceptable? Is what they're asking. Can we do this? No. Why? Sir, first, prior period item means, what is the definition of prior period item? Prior period items means they are those items or they are those income and expenses which arise in the current year. Due to what? Due to some errors or omission that you committed in preparation of previous financial statements. In the last year or in the last many years, we don't know. You have done some mistake. That mistake you identified in the current year. Such a component we call it as what? Prior period item. Here, did we do any mistake by creating that provision, or we should have created provision? We should have created provision. So is there any mistake? No. That means, is there any omission? No. That means, is this a prior period item? No. Fine now people. That means, what should we treat this as? See, AS5 only talks about accounting policy, accounting estimate, exceptional item, extraordinary item and normal item. If it is normal item, you don't need to give any disclosure. But sir, how often do you lose helicopters? Every day. That to 4 helicopters you will lose every year. Is this a recurring item or a very rare item? This is a normal item or extraordinary item? Extraordinary item. So you will book this as what, sir? Extraordinary item. And AS5 says that extraordinary item you should give a separate disclosure. That's all you need to call out. Most of the RTP questions here are theory oriented. Okay, pretty straightforward. But everything is based on AS. They have not given much other topics or questions. Mostly questions are on AS only. If you need some time, I'll wait, or if you have got it, I shall move forward. Understood everybody? Can I move along? Online also? Everyone in the online, respond. Are we comfortable? Okay. AS7, this is a repetitive question. It's question number 13 in our class notes. AS7, or in fact AS9 ka one question is there. We will go through. We know this concept. In fact, I've explained this in class also. But any which way, this I will do it again. Okay, check this. Mithya Limited enter into an agreement with Satya Limited for sale of goods costing 8 lakh at a profit of how much? 20% of cost. Calculate profit, sir. Profit is 20% on cost. How much is cost? 8 lakh. 8 lakh or 20% you calculate. How much is that? 1 lakh 60,000. So that means what is the selling price? 9 lakh 60,000. Any problem? So we have made an arrangement. Mithya has made an arrangement with Satya that they will sell the goods for a value how much? Sale value 9 lakh 60,000. So far good. The sale transaction took place on 1st February. So the agreement is already, the execution of sale is already done. On the same day, Satya entered into another agreement with Mithya, same person, right? To resell the same goods at 10.8 lakh. What sort of arrangement is this? First you sell and later same goods you are buying back. This arrangement only, what do we call it as? This is what? Is this revenue? No. When you sell the goods initially and later if you buy back the same goods, it is not a sale transaction. Rather, it is what arrangement? It's a finance arrangement. Can you book a revenue as per AS9 for finance arrangement transaction? No. Whatever amount you have received, you should show it as a loan or as an advance. Hence, yes people? Okay, that's what we have to apply over here. How much did you sell the goods now for? 9 lakh 60,000. Later on, after a few months, how many months is that? On 1st February you sold. When are you buying back? 1st August. Count the period from 1st February to 1st August if you count. How many months is that? 6 months. After 6 months you will buy the same goods back at what value? 10 lakh 80,000. Okay, so that means this is a pure finance arrangement. It's like a loan. Now you have taken a loan of 9 lakh 60,000. After 6 months you will repay how much? 10 lakh 80,000. So the difference between these two is what? 960 and 180 ka 10 lakh 80,000 and 960 ka difference is nothing but your interest charges or finance charges. Comfortable, sir? That's all. State the treatment of this transaction in the books of Mithya as on 31st March 2024. The predetermined selling price covers holding cost of Satya, blah blah blah. They are asking you to prepare journal entry also. Okay, can we do it? Okay, in the books of Mithya only first sold, no? First Mithya is selling and later they are repurchasing the same goods. So can we recognize it as sale on 1st February? Can we book a sale? No. What will we show it as? Advance. So the journal entry you will pass on 1st February is what, sir? Bank account debit. How much sale value? 9 lakh 60,000. So you can call it as loan or you can call from advance from Satya. How much is that? 9 lakh 60,000. Any problem? Now be careful. Take your calculator. What is the difference between these two? 10 lakh 80,000 minus 9 lakh 60,000 is how much? 1 lakh 20,000. What is that 1 lakh 20,000? The interest is 1 lakh 20,000. Correct, people? 10.8 lakh minus 9.6 lakh. If you do, the difference is nothing but interest charges or finance charges. Now the question is, you know already, interest you book it on what? One shot or a monthly basis? Monthly basis. Check over here. The current year is ending on which date? 31st March. When did you enter into this transaction? February. You sold the goods in February. You are repurchasing current year or next year? Next year. Correct? No. That means current year, should you book any interest? Yes. Entire 1 lakh 20,000 will you book it as interest? No. This interest is for how many months? 6 months. You enter into a sale transaction on 1st February and your year is ending on 31st March. So how many months? February, March. So in the current year, you need to book the interest only for 2 months. So calculate. What is the journal entry for interest? Interest account debit to advance. Interest you are not paying. No, at one shot you will pay the interest. So you don't write to bank because you are not paying this interest now. 10 lakh 80,000 what you pay later on includes interest. So the journal entry you will pass is interest account debit to advance from Satya. How much is the interest? If you do this, you will get how much? 1 lakh 20,000. That 1 lakh 20,000 is the interest for how many months? 6 months. For 2 months, how much? If you prorate, you will get how much, sir? 40,000. 40,000 is the interest for the current year. Any problem? And where will this interest charges go off to? Interest is an expense. Where will this go off to? P&L account. That's the transfer entry. Then are people? That is what they asked in the current year. That's all you had to pass. For your reference, I have also bought it for next year. Though they have not asked next year transaction, this is just for your reference. How much is the total interest? 1 lakh 20,000. How much did you book it in the last year? 40,000. That means balance interest of 80,000, you will book it in the next year. So the entry will be same. Interest account debit to advance from Satya, how much? 80,000. Either you can directly get or you can recalculate. 10 lakh 80,000 minus 960. If you do, you will get total interest. That total interest is for how many months? 6 months. In that 2 months, you have already booked. So how many months is pending? April, May, June, July, right? So 4 months if you book, you will get 80,000. Any problem? Then, when you have to repurchase? 1st August. On 1st August, what do you have to do, sir? You have to repay this loan, correct? Because when you repurchase, obviously money will come in or money will go out. Money will go out. So on 1st August, in fact, the journal entry will be advance from Satya account debit 10,80,000 to bank account 10,80,000. That way, this advance account will completely get nullified. And this interest charges is an expense that will be transferred off to next year ka P&L account. This they have not asked, just wrote it for your reference. I'll give you a minute. If you have any questions, you can ask. If you have got it, we will move on. So we are doing a quick review on this thing. I have explained it to you with some examples in the class itself. But anyways, not a problem. Clear? Here also okay? Can I move on to the next question? Online also? Comfortable? Some thumbs ups. Okay, great. Thank you. Alright. Sir, AS 10 ka question and AS 11 ka questions are repetitive. I've given you question ka reference also over here. This is question number 26 of our class notes and question 11 of our class notes. So repetitive ones will not waste time. I don't have so much energy also now. Okay. Alright. Now AS 14 ka actually homework question. We don't have this question exactly, but we have done similar question. Pretty straightforward, but any which way, 2 minutes we'll quickly review it off. Asta Limited is absorbed by Nishta Limited. So Asta is absorbed by Nishta. So Nishta is the purchasing company. Asta is the selling company. Correct, people? Okay, the consideration being taking over liability, payment of cost of absorption. Cost of absorption simply means amalgamation expense or realization expense. Not exceeding how much? 10,000. The purchasing company will pay the selling company amalgamation expense worth how much? 10,000. Is this PCR? Is this PC? In fact, you check the requirement. You need to calculate what? Purchase consideration. Sir, is amalgamation expenditure purchase consideration? No. PC means what? PC means what? The amount paid by the amount paid or payable by the purchasing company to the owners of selling company. And who are owners of selling company? Equity shareholders and preference shareholders. So is amalgamation expense my PC? No. So they have given unnecessary information. So is this relevant for our calculation or irrelevant? Irrelevant. Cut it off. Next, payment for 9% debentures of 50,000. Sir, the moment I hear debentures, I will not even bother reading further. Why? Are debenture holders of selling company owners? No. PC means what you pay to the owners. Are debenture holders owners? No. That means whatever you give debentures, you can give it at par, premium, discount, whatever. Is it part of PC or not a part of PC? That means I'll not even bother reading that particular sentence. Understood? Now go further. And the payment of 15 rupees per share in cash. On one share, how much cash you are giving? 15 per share. And allotment of 3 11% preference shares of 10 each, great, and 4 equity shares of 10 each at a premium of 20%. I mean, these new shares, are you issuing it at 10? No, you are issuing it at how much percent premium? 20% premium. So the issue price is how much? 12 rupees. Yes, fully paid up for every 5 shares in Asta. So if Asta ka shareholders, no sir, if they are owning any shares, they'll get 3 components. Can you tell me what and all? Equity shareholders of the selling company, that is Asta, will get 3 things from the purchasing company. What are those? One, cash. Another one, preference shares. Another one, equity shares. 3 components are given to equity shareholders of selling company. Is this PC? Very much yes. Can we calculate that? One by one, everybody good? Are you in Bangalore or Chennai? I'm in Bangalore, macha. Chennai, I came back. Yeah. Since many days, I'm in Bangalore only. One second. Okay, great. First, sir, how much cash you are giving per share? 15 rupees. How many? Check this. Number of shares in the vendor company as in selling company. Okay, how many shares we have in the selling company? 1,50,000 shares of 10 each. So, how much is the cash, sir? On one share, we will give a cash of 15 rupees. On 1,50,000 shares, how much is the cash? 1,50,000 into 15, if you do, you'll get 22,50,000. Any problem? This is PC given in the form of cash. To whom? Sir, all this PC is given to whom? To equity shareholders of selling company. And what is the name of that selling company? Asta, right? That's what we read. Yes. Yeah, Asta Limited. To Asta Limited ka shareholders only we are giving all this. So everything will become part of PC. Any doubt? Any confusion? Can I move on? Alright. Next, what did you give? That's all you gave, or you also gave preference shares? Preference shares. Whom did you give this preference shares to? Say, equity shareholders only. Straightforward or in some ratio? Ratio. What ratio? 3 preference shares for every how many shares? 5 shares. Yes. 3 preference shares. I'll read the sentence in case you're confused once again. 3 11% preference shares of 10 each. And also they will give 4 equity shares of 10 each. They're giving equity shares also, they're giving new preference shares also. Both they're giving. But in what ratio? For every 5 shares held in Asta. So arrangement is like this. If the equity shareholders have 5 shares in the old company, then they will get 3 new preference shares of the new company or purchasing company. Comfortable? If you have 5, you will get 3 new preference shares. Do we have any 5 shares in the selling company? Check how many shares we have in the selling company. 1,50,000. If you have 1,50,000 means how much? That's the proration. Yes, people? If you prorate, what are you going to get? 1,50,000 into 3 by 5. By doing this, what will you get, sir? Number of preference shares. We want number of preference shares or PC is in value? Value. Preference shares ka face value is how much? 10. And is it issued at premium or par value only? Only new equity shares are issued at premium. Preference shares are issued at 10 only. So multiply by 10, you will get preference shares ka value to be how much? 9 lakh. This preference shares is also given to whom? Equity shareholders of selling company itself. Done or one more? Done or one more? Right? No, one more. 4 new equity shares for every 5 equity shares held. So that means there we are also giving equity shares now. Again, if you want, you can prorate it over here. Old and new. If you have 5 shares in the old company, how many new equity shares will you get? 4. Do you have any 5 shares in the selling company or we have 1,50,000? 1,50,000 means how many new shares? So if you prorate, what you're going to get? 1,50,000 into 4 by 5. By doing this, what will you get, sir? You will get 1,20,000. That is the number of equity shares. We want number or we want value? These equity shares ka face value may be 10, but is it issued at face value or premium? How much percent premium? 20%. So issue price is how much? 12. So multiply by 12, you will get the value. How much is that? 14,40,000. Adding all this, you will get the total PC in the question to be 45,90,000. Okay, just observe. It's a very straightforward PC calculation. Wala problem. All this we have done in our regular class itself. Oh, looks like I become tomato. Full red. Okay. All right. Thank you. Online. Okay now. Can I move forward? Yes. Okay. Question number 11. Sir, in case you have forgotten few things, not a big deal. All right. I do understand that advanced accounting ka last batch happened maybe 4 or 5 months back. So it's quite natural that we have learned new things of new chapters and new subjects later on. So many things. If you have forgotten, not a big deal. All right. In that case, you watch all these videos once you have prepared. Once you have gone through entire syllabus of advanced accounting, then you will go through this. That way you will feel that all these are pretty straightforward. Okay. Or this acts like a checkpoint for you. How much of it do you actually remember? Okay. All right. Now, next question is on accounting standard 16. Question number 11. How interest be capitalized or how will interest be capitalized when qualifying assets are funded by borrowings in the nature of bonds that are issued at discount? Sir, what does AS 16 say? If you have any borrowing, on that borrowing, if you are incurring any borrowing cost, if that borrowing is used to purchase, construct or produce a qualifying asset, then that borrowing cost, will you transfer it to P&L or capitalize? Capitalize, meaning you'll add it to the cost of qualifying asset. That's what AS 16 ka provision says. Now here the problem is, this particular question is a good concept question. What they are saying is, now we have a qualifying asset. Maybe let's say we are constructing a building. For that we need money. We did not take bank loan. How did we raise this money? Through bonds. We issued bonds, and whatever money we received from that bond, we are using it to construct a qualifying asset. Done. So in this case, what you will do? Very simple. On the bonds you will pay interest. What will you do with that bond ka or a debenture ka interest? Will you transfer it to P&L? No. You will capitalize it and add to the cost of building. If qualifying asset is building means, you will add it to the cost of building. Yes, sir. That part of it is clear. They are not asking about that. They are saying if these bonds are issued at discount, what you will do? If these bonds are issued at discount, what you will do? Okay, I'll read off this whole data again, tell you. It's a good concept question. X Limited issued in year 1 a 3-year 10% per annum interest paid annually bond with a face value of how much? 1 lakh. So interest is always calculated on what? Face value. Take your calculator. 1 lakh or 10% if you do, how much are you going to get? 10,000. So interest every year is how much? 10,000. But these bonds ka face value is 1 lakh, but it was issued at what price? 90,000. That means these bonds are issued at par or at discount. How much discount? The total discount is how much? 10,000. 1 lakh worth of bond you issued only for 90,000. So the total discount is how much? 30,000. Any problem? No. Let that information be there. To finance, this bond were issued to finance a qualifying asset which is ready for intended use by the end of year 2. So that asset will be ready in first year only or end of second year? Second year. Bond ka term is how much, sir? 3 years. But qualifying asset is ready by how many years? 2 years. What does AS16 say? Can you capitalize 3 years ka interest cost? No. Till the qualifying asset is substantially complete. Till then you can capitalize. Once the qualifying asset is ready to use, capitalization stops. This we learned it as cessation provision in AS16. Yes, no? When the qualifying asset is substantially complete, you stop the capitalization. Correct, people? Here, asset is ready by end of which year? Second year. That means by the end of second year, you will stop your capitalization. Compute the amount of borrowing cost to be capitalized if the company uses amortization of discount on a straight line basis. It's quite simple. 1 lakh worth of bond you issued for how much amount, sir? 90. That means how much discount? 10,000. For the company, this discount is an income or an expense? Expense. This bond came why? Or this discount came why? Because company issued bond. And bond is issued for 1 year or 3 years? That means this 10,000 is 1 year expense or 3 years expense? 3 years. So this 10,000, no, they are saying the company is amortizing to P&L on a straight line basis. That means this 10,000 expenditure, they are transferring it to P&L over 3 years. That means every year, how much is it? 10,000 divided by 3, if you do, you will get 3,333. Last year, you take it as 3,334 to round off. Yes, people? Any problem? Now you will have to go back to borrowing cost ka definition. Borrowing cost means only interest, sir. In fact, I told you also, borrowing cost means what? Interest and other charges incurred with respect to borrowing. Borrowing cost is not just interest. Borrowing cost means interest and other incidental charges, meaning other related charges that come along with the borrowings. Now, when you take a bank loan, on bank loan you have to pay interest. But before sanctioning the loan, bank also processes your file and they charge something called processing fees. Even processing fees is what? Borrowing cost only. So interest charges is not just borrowing cost, even processing charges will become borrowing cost. Here we have processing cost or we have another related cost. Other related. What is another related cost on bond? Discount. That means here, no sir, borrowing cost will not be. How much is the interest every year? 10,000. Is borrowing cost only 10,000? No. What is the discount per annum? 3,333. So the borrowing cost to be capitalized in year 1 is not just 10,000 interest, but also the discount charges every year. How much is that? 333. That means in the first year you will capitalize borrowing cost. How much, sir? 13,333. Understood, everybody? Similarly, in the second year, how much is the interest on bond? Interest on bond is always calculated on face value. How much is face value? 1 lakh. And what is the interest rate on bonds? 10%. So the interest for second year also will be how much? 10,000. For second year also, how much is the discount? Every year up to 3 years, the discount is 3,333. So second year also discount is this much. So second year also you will capitalize how much? 10,000 or 13,333. That is the concept from this particular question. Understood? So what is the takeaway? Borrowing cost means it does not mean only the interest. It also includes your other related cost. Other related cost could be here discount. Or if you are in maybe here they give discount. In your examination where they can give bonds are redeemed at premium. Bonds can be redeemed at premium. Even that premium also becomes a cost. Understanding? So same, all this, all right, the bonds or debentures issued at discount, they are redeemed at premium, processing charges in case of bank loan, all that are also what? Borrowing cost. Same funda. Okay, same. You calculate the total premium, amortize it over the term. If premium is, let's say, 5,000 rupees, or let's say premium is 30,000 rupees. 30,000 is the premium relating to what? It's though the premium we will pay in the third year. Is it third year expense or all the 3 years ka expense? So 30,000 divided by 3 you do. How much you going to get? 10,000. So add to the interest cost of 10,000 to add also redemption premium of 10,000 and capitalize. Understood? If it is issued at premium, can we subtract? The treatment is silent. In my view, you can. In my view, you can. Because obviously your cost will reduce there. So in my view, you should. Okay, but I've not seen any questions. So, but yes, I think you're right. We can subtract that. That's a good question. Yes, people? If you just check, I've only calculated for 2 years. Why not for third year? In third year also you have interest charges of 10,000 and you have discount of 3,444. Why didn't I calculate that? Sir, the qualifying asset is ready for intended use by which year? second year. That means the capitalization stops. Here I've written what? Borrowing cost to be capitalized. Capitalization stops when? By the end of second year, because qualifying asset is ready by the end of second year. The third year ka interest of 10,000 and discount of 3,444 will be transferred where? P&L account, as qualifying asset is already ready for its intended use by the end of second year itself. That's all. That way this is a good question. So I'll just give you a minute, observe and ask me if you have any doubt, people. Online also okay? Easy peasy. Can I move on? Or need a minute? Done? So overall takeaway of this question is what? Simple. Interest cost is not just the borrowing cost. If you are redeeming the bonds at premium, or if you are issuing the bonds at discount, even that is also your borrowing cost. Even they can be added to the cost of qualifying asset. That's a takeaway of this particular question. AS17 is a repetitive question. It is there in our class notes also. 18 I'll do. Okay, or rather AS18 ka question, that is question number 13. Will transaction with the related parties for service provided or received at free of cost be required to be disclosed? Normally related party transactions, should we have to disclose? Yes. But they are saying this particular related party transaction happened at free of cost. We gave the service not by charging money, we gave it at free of cost. Still, should you disclose this is what they're asking. You got the question? Alright. So for that you need to understand the definition of related party. Related party transaction. Related party transaction means they are those transaction which involves transfer of resources or obligation of whether price is charged or not. Or before the definition, maybe I'll give you a small example. They have also given one example. Let's look at this. H Limited is holding company. S Limited is the subsidiary company. Is holding company and S Limited related parties? Is holding company, subsidiary company related party? Yes. One company has either a control or a significant influence over another company. They both become automatically related parties. Is H Limited and S Limited in this case related party? Yes. Why? Because H is I've assumed it to be holding company and S I've assumed it to be subsidiary company. So are these related party? Yes. Now what has happened is H Limited has given some installation service. S Limited had one machinery. They wanted to install that. They did not appoint outside vendor. H Limited only sent one of its employee and told install that S Limited ka machinery. So H Limited gave one service, installation service, but H did not charge any money. It gave it at free of cost. That means is this a related party transaction? Yes. But is there any money coming in here? Money coming in or money going out? No. Such a transaction should we disclose is what the question is trying to ask. Now you got the clarity over question? The answer is yes, because a related party means it is not necessary that resources has to be transferred. Okay, a related party means some resource should have got transferred. Resource means some asset to some service would have got transferred, or an obligation should have got transferred. Obligation means, let's say subsidiary company S Limited, they've taken a loan from SBI. S Limited has taken a loan from SBI. H Limited gave the guarantee. H Limited gave the guarantee. Who took the loan? Subsidiary company. Who is giving the guarantee on that loan? Holding company. So if subsidiary company defaults on the loan, if they don't pay the SBI loan ka EMI, then what? Bank will catch hold of who? Holding company, because they have given guarantee. That is what we mean by obligation. Some resources should have got transferred or some obligation should have got transferred, and it doesn't matter whether you have charged the price or not. Okay, if obligation or resource, if it is transferred, means here obviously if you have given installation service, means one service has got transferred. Whether you charge money for that or not is irrelevant. Still disclosure needs to be compulsorily given. Understood everybody? So the summation of this concept is what? The final answer is what? Should we disclose this? Is it a related party? Yes. Should it be disclosed? Yes. They've given the example. Check. A Limited has a corporate communications department which centralizes public relations functions for the whole group of A Limited and its subsidiaries. Now A Limited is a main parent. This parent has many subsidiaries. Now normally, sir, if it's a listed company and all, they have to conduct a quarterly meetings and announce to the shareholders, this is my result and all. Now all these are sensitive information. Now imagine now if Mukesh Ambani comes tomorrow on TV and says doomsday is coming, Reliance will be going down. What will happen? Shares will fall left, right, center. He said it as a prank. He said it, let's say, as a prank. But what will happen? People will take it as a prank or take it very seriously. very seriously. So hence, all when they're listed companies, so holding company will take an initiative and tell the subsidiary company, you don't worry about the public management. We have one corporate communication team. They will do all these meetings. Okay, your company ka meetings also we will only do our only, like a PR team. Actors, they don't speak. They always get that script of what to say, what to write in Instagram. You see lovely messages coming in Instagram, LinkedIn and all. Correct? Do you think on the Twitter and all actor wrote that? Or some PR team is doing? Some public relationship team is doing? Same here, we have one corporate communication team. We are handling all the subsidiary ka, this communication with the company ka communication with the public. No charges are however levied by Air Limited on its subsidiary, and accordingly these transactions are not given accounting recognition. That means holding company is giving the service to a subsidiary company by charging some money or free of cost. Free of cost. Sir, if there is no money coming in, no money going out, will you pass any journal entry for it? Journal entry we can pass. See, journal entry works on money measurement concept. If money is coming in, money is going out, we will pass journal entry. If there is no money coming in, no going out means, will you pass any journal entry? No. Would these transactions constitute a related party transaction, and should you disclose it is what they're asking. Should you disclose this? Yes, because a related party transaction need not be necessarily transferred for money. Even service given at free of cost is also a related party transaction. That's what we have to say there. It's a theory question. Comfortable? Need a minute or move on? Move on. Question number 14 is repetitive. In fact, I've solved it here also for your reference. Same question or similar question is there in our class notes also. Finding out unearned finance income. How do you find out EFI? Gross investment minus net investment. AS19 ka question. A similar question is there in our notes. Anyway, I've put it up here also for your reference. AS20 is a good question. 1 minute. Go through that question. This cold is difficult to manage, I think. Excuse me. Can I start? Alright, AS15, good question. AS15, my concept we know, just that they have nicely applied that particular concept. So we'll see what we can learn from this particular question. XYZ has a wholly owned subsidiary, BC Limited. The group prepares consolidated financial statement for the year ended 31st March 2024. Okay. XYZ has a wholly owned subsidiary, BC. So XYZ is the parent company or holding company. BC Limited is the subsidiary. So XYZ will incorporate BC ka data and they'll prepare consolidated financial statement. XYZ in their separate financial statement. Separate financial statement means X Limited ka its own financial statement. It has incurred how much loss? 2 crore loss. X, their own company ka situation is what? Loss. How much? 2 crore. But however, consolidated profit in the group is 40 lakhs. X ka their own loss is 2 crore, but if you add all the company ka profit or loss, totally you will get how much, sir? 40 lakh profit. Maybe parent company has made a bumper loss here. Subsidiary company has made some good profit. So hence if you add up, you are still getting what? At consolidated level, you are getting a profit of 40 lakhs. Pretty basic. Okay. XYZ has 5 lakh shares outstanding as on 31st March 2024. Further, it has granted option to issue equity shares as at that date. It has granted options. It has granted options. That means what? What is this hinting towards? We have done such question in AS20. Okay, no problem. I'll read. In respect of such options, 1 lakh shares are considered to be shares issued for no consideration. This only we used to write in our class as nil consideration. Remember? Options. Options. We used to give some ESOP or something to the employees. Will we used to give it at fair price or lesser than fair price? Let's say the market price of the share was 50 rupees. We used to give this option at, let's say, 30 rupees. That means you are giving the shares at a fair price or lesser price? Lesser price. That's what we used to take it and calculate number of shares issued for nil consideration. So that is what this basically a what? Your dilution adjustment for your weighted average number of equity shares ka calculation. Normally we calculate this, but here in this problem they only given. This is the dilution adjustment with respect to options. If you open your notes and flip over the options questions, you'll find this. Okay, number of options issued for nil consideration is 1 lakh. So this will be helpful for our DEPS calculation. There are no changes in income or expenses that are expected from the issue of shares. Calculate BEPS and DEPS for both SFS and the group. So till now we have done questions on calculating BEPS and DEPS only for SFS. Here they are asking you to calculate BEPS and DEPS for CFS also. Both in SFS and CFS you need to calculate BEPS and DEPS. Pretty straightforward. Let's calculate. Small concept, that's all. First SFS. Sir, how much SFS means you will take group ka data or only X ka data? X ka data. How much is X ka loss? 2 crore. Sir, for loss we calculate EPS. Yes, the name is what? ASMITD talks about earnings per share. It is not profit per share. It is earnings per share. Earnings could be positive or it could be negative. Even if you make a loss, still will we calculate EPS? Yes, but it will be shown as a negative number. So how much is X Limited ka their own company ka loss? 2 crore. Okay, and how many shares they have? 5 lakh shares. Basic EPS. So 2 crore divided by 5 lakh if you do, you will get basic EPS how much, sir? 40. Any doubt till here? Comfortable? Let's calculate it for CFS also. At CFS, how much is the profit of the group? 40 lakh. How much does the group means? Obviously X. When you prepare consolidated financial statement, you will show what? Subsidiary ka share capital will you show in CFS? No. Only which company ka share capital will come? Holding company ka. So which share will be taken for CFS purpose? 5 lakh only. Profit is how much? 40 lakh. Number of shares is how much? 5 lakh. So that means when you calculate basic EPS at CFS level, it will come 8 rupees. Any doubt on this? This is on what, sir? Basic EPS. Next is your diluted EPS. Sir, this is options. Will options have any each ka dilution adjustment? Remember, we take each, we take what? Basic EPS ka each, add dilution adjustment. Then you will get what? Each for diluted EPS perspective. Then we'll take Wales for basic EPS purpose. Then add dilution adjustment. Then we'll get what? Wales for DEPS purpose. Here, do we have any dilution adjustment in numerator? No. Because all the shares, this options what you gave, is it purchased now or it will get exercised in future? It will get exercised in future. Just that through DEPS, what are we trying to calculate? Since these options are issued at fair price or lesser than fair price? Lesser than fair price, some shares are issued for consideration, for nil consideration. How much is that? 1 lakh. That means this will be only what, sir? Dilution adjustment relating to Wales. Ishka will still be how much? 2 crore only. Vanes will be how much? For diluted EPS purpose, Vanes will be 5 lakh plus number of shares issued for nil consideration. How much is that? 1 lakh. So the total number of shares will become 6 lakh. All this problem we have done, people. Okay, yes, everybody? Alright, so how much is you getting diluted EPS? 33.33. Is this okay with you so far? Let me put it across. Let that be there. This is not actually right. I'll just tell you the concept a little later on. Let's do a similar calculation for CFS. How do you calculate? Same. Each is still how much? 40 lakh. Divided by Vanes. Vanes will be 5 lakh or you have some shares for nil consideration. How many shares for nil consideration? 1 lakh. So 5 lakh plus 1 lakh you do. So 40 lakh divided by 6 lakh if you do, you'll get 6.667. Any problem? Sir, at CFS level, I don't see any problem. Why? How much was basic EPS? 8 rupees. How much is diluted EPS? 6.667. So diluted EPS should be greater than basic EPS or it should be lesser? Lesser. This is 8, this is 6.67. Any problem or perfect? Perfect. But look at SFS data. BEPS is how much? It's not profit. It is loss per share. How much is loss per share at SFS level? 40. But at DEPS at SFS level is how much? 33.33 negative. This 2 crore is still loss. Correct? No? So loss per share is increasing or reducing? Sir, we have told you this scenario. Anti-dilutive EPS, will you report or you should not report? You should not report. We have discussed this. Yes or no? And when do you say it is anti-dilutive? If you're working from profit angle, if DEPS is greater than BEPS, if DEPS is diluted EPS, if it is greater than basic EPS from profit scenario, then it becomes anti-dilutive. Here we are working from profit angle or loss angle? Loss angle. From loss angle, when can it become anti-dilutive? If diluted EPS, if it is lesser than basic EPS, then it will become anti-dilutive. Yes or no, people? Guys, yes or no? So basic EPS at SFS level is how much? 40. But diluted EPS is 33.33. That means loss is actually reducing. So that means what is this? What sort of EPS is this? Normal or anti-dilutive? This is an anti-dilutive. Anti-dilutive DEPS, do we report? No. In fact, I've told you also, whenever you get anti-dilutive number, what do? BEPS and DEPS you report it at same number. How much is BEPS? 40. That means DEPS also you'll report it at what? 40 itself. This 33.33 you cannot report because it is anti-dilutive. That's a concept they have used. This concept we know, we have applied in class. Just that we applied at SFS level. They applied it at SFS and CFS in this particular question. That way this particular question is good. I'll give you a minute, just observe. This is also a good question in my view. If you have any doubt, you can ask. Just give you a quick minute there. All good online? Understood everybody? Okay, what is it? Just to summarize, what is this question all about? This question was on whether will you report. First of all, we learned how to calculate BEPS and DEPS at SFS level and CFS level. Is that any calculation, any problem? No. Every data was already given. One more thing you need to keep in mind is anti-dilutive provision. When will it become anti-dilutive? If it's a profit angle, then if DEPS is greater than BEPS, then it becomes anti-dilutive. If it is loss angle, then when it will become anti-dilutive? If DEPS is lesser than basic EPS, then it will become anti-dilutive. And anti-dilutive number do we report? No. Whenever you get anti-dilutive DEPS, what do we do? Basic EPS and diluted EPS, you report at the same number. How much was basic EPS here? 40. So diluted EPS, you will not report at 33.33, you will report it at 40 itself. That's all is the takeaway of this particular question. Can I move on to the next question, sir? Good one according to me. Okay. Question 17, 18 both are repetitive, nothing much to there. 16th is a good question. Okay, I'll take you through. 19th is a repetitive. So 2 more questions if you are done means this particular RTP is done. In all the questions so far, question number 16 I would say is the good one. Okay, this one and probably the previous one, EPS ka. Concept wise, I feel that these are a better framed question. So let's see what we can learn from this. First, there are 2 parts of this question. First part is pretty basic. We have done this, we know this. Second part is a new framing. So we'll see what we can learn from that particular concept. First, let's go through the question. ABC Limited prepares its accounts annually on 31st March. On 1st April, it purchases machinery at a cost of 1,50,000. At year beginning, they purchased a machinery. The machine has a useful life of 3 years and salvage value is 0. Although it is eligible for 100% first year depreciation allowance as per tax purpose. In tax, should you have to wait 3 years to claim depreciation or 100% in first year? 100% in first year. You know, you have some scientific equipments and all on which you can charge 100%, 150% and all. Maybe that wala asset this is. So tax laws is saying you don't have to wait 3 years to claim depreciation. 100% depreciation you can claim in which year? First year itself. But in accounts will we do this or 3 years? 3 years. So accounts depreciation and tax depreciation matching or not matching? Not matching. Whenever there is when there is a difference, to plug this difference only we create DTA or DTL. So let's see. The straight line method is considered appropriate for accounting purpose. So okay, ABC Limited has a profit before depreciation and tax how much? 2 lakh each year. Profit before depreciation, underline that, before deducting depreciation and tax, profit is 2 lakh. Corporate tax is how much? 40%. The purchase of machine cost of 1,50,000 in 2022 gives rise to a tax saving of 60,000. Leave that and all is goalie, we don't need that. Corporate tax rate has been assumed to be same in each of the 3 years. Meaning all the 3 years tax rate is how much? 40% only. Calculate deferred tax and pass the necessary journal entries. First part, this part is very straightforward, nothing much. So let's start. I've solved it, look at it over here. First is a case where tax rate is changing or same every year? Same. How much is that tax rate? 40%. That's what I've taken here. Good people. So let's calculate. First, we are using the asset for 1 year or 3 years? 3 years. So I'm having particulars column and 3 years column. First, what is depreciation as per tax? What does the tax law say? You can claim 100% depreciation in first year itself. How much did you buy the asset for? 1,50,000. That means in that as per tax laws, depreciation will be entire 150. Because tax law says you can claim depreciation in first year itself. Will any depreciation come as per tax in second and third year? No. Full you claimed it in first year itself. But however, accounts. In accounts, what will be depreciation, sir? You bought the asset for how much? You bought the asset for 1,50,000. Salvage value is 0. What is the useful life of the asset? 3 years. That means in accounts, the depreciation will be how much, sir? 50,000 every year for 3 years. Any problem? Any problem? No. As per tax, the depreciation is 150. As per accounts, the depreciation is only 50. Are these numbers matching? No, there is a difference. If you just check, these are what? Permanent difference or timing difference? These are permanent difference or temporary difference? Temporary. How? Check the total if you want. What is the total depreciation as per tax? 1,50,000. What is the total depreciation as per accounts? 1,50,000. Year on year there is a difference, but at total level they are same. So this is an example of what sort of a difference is this? This is a temporary difference, or also known as timing difference. And for temporary timing differences, do we create DTA or DTL? Yes, that is what we need to calculate here. In fact, can you guide me? We wrote one equation also, remember? Depreciation as per tax is 150, as per accounts it is 50. So you remember which equation? Depreciation is an expense. This equation, do you remember? If expense as per tax is more in the current year, if expense as per tax is more in the current year, then what it implies? If expense is more means profit will be, or a taxable profit will be what, sir? Taxable profit in the current year will be less. If taxable profit in the current year is less means, if profit is more means obviously profit will be less. If profit in the current year less means tax paid in the current year also is. Tax paid in the current year is also less. Sir, these are permanent difference or temporary difference? Temporary. That means this will be forever there or it will get reversed. Current year you might have paid less tax, but in future may, when this gets reversed, in the future may you have to pay more tax. That's what we used to write. Tax payable in future will be what, sir? Tax payable in the future years will be more. Sir, if you have to pay more tax in future, it's an asset or a liability. So what do we create in this case? Deferred tax liability. Comfortable now? And we create DTA, DTL on the difference or on the taxable difference? Taxable difference. So how much is the difference here, sir? 150 minus 50, if you do, difference is how much? 1 lakh. On 1 lakh, will we create deferred tax liability? We got to know we have to create deferred tax liability. 1 lakh? No. 1 lakh multiplied by what? 40%. How much is that? 40,000. Any problem, anybody in the first year? Done now. Can we review it for second year? Okay, second year, do the same check. How much is depreciation as per tax, sir? 0. As per accounts is how much? 50,000. I mean, compared to accounts, tax record is having more depreciation or less depreciation? Accounts depreciation is 50, tax depreciation is 0. That means expense as per tax record is less. Compared to accounts, tax recording in the next year is having less expense. Expense is less means profit in the current year will be more. That means tax paid in the current year also will be more. In the future year, may you will pay less tax. So what will you create? Deferred tax asset. But hang on. In the second year, will you create deferred tax asset? No. First year, you already created what? Deferred tax liability. Will you create both DTA and DTL? No. Instead of creating DTA for the second year, what do? We reverse. We reverse what? Deferred tax liability. How much is that reversal? 50,000 ka 40%. How much is that? 20,000. Comfortable? This much DTL will get, instead of creating deferred tax liability for deferred tax asset for 20,000, you reverse deferred tax liability for 20,000. That's it. Okay. It's a simple one. It's the same thing. We have done all these questions. Not even one bit is different here. Okay. Yes. Someone is saying once more. Forgotten, no? You have attended our regular class, AS22. This we have done in 4 or 5 questions. Not even one bit is new on this. Okay, nonetheless, no problem. I'll explain it to you once again, just to be on the safer side. Review, people. It's better to revise. Okay, otherwise you tend to forget it. Because there's a 4th or 5th question we have done in the class, similar concept. Okay, just check over here maybe. How much is expense as per tax? 1,50,000. How much is expense as per accounts? 50,000. So compared to accounts, tax is having in the first year less depreciation or more depreciation? This is 150, here it is only 50. That means the tax in the current year, expense as per tax record in the current year compared to accounts is more. If expense increases means, use your common sense. If expense increases means profit will increase or reduce. If expense as per tax record is more means taxable profit in the current year will be less. If taxable profit in the current year is less means you pay tax on taxable profit only. No? So if taxable profit is less means tax paid in the current year is also less. But these are permanent difference or temporary? The first year you have got the difference, but in future years may difference will get reduced. So current year you might have paid less tax, but in the future year may you will pay more tax. In the future may, if you have to pay more tax means you have a liability to pay more tax. Hence we create what? Deferred tax liability. You take the difference, multiply tax rate, you will get the deferred tax liability amount. So basically 1 lakh of 40% if you do, you'll get deferred tax liability of 40,000. Okay now, this for first year. Now okay. Okay, second year, same drama, compare. Expense as per tax is how much? 0. As per accounts is how much? 50,000. That means in the second year, expense as per tax is lesser. Expense as per tax is lesser when compared to accounts. So if expense as per tax is less in the current year, means taxable profit in the current year will be more. Tax paid in the current year will be more. But in the future year, current year you might have paid more tax. In the future year, you will pay less tax. In the future year, you will pay less tax, means it's like you already paid some advance tax. I mean, this becomes what? On this, you'll create what? Deferred tax asset. In fact, I've given you 4 equations, right? 2 equations for expense, 2 equations for income. Both are getting triggered here. Yes. That means in the second year, will you create what, sir? You have to ideally create what? DTA. Sir, on the same component, you will create both DTL and DTA? No. Instead of creating DTA in the second year, what will you do? Whatever DTL you had in the previous year, that only you will reverse it. How much we have to create? 20,000. Instead of creating DTA for 20,000, we reverse deferred tax liability for 20,000. That's what happens in the second year. Any problem, people? Clear? Third year, same drama. What is expense as per tax? 0. As per accounts is how much? 50,000. That means what? Expense as per tax is compared to accounts is less. That means the taxable profit in the current year will be, third year will be more. Tax paid in the third year also will be more. Future year may less tax. Will you create DTA? No. Do you still have deferred tax liability balance? Yes. Instead of creating DTA in the third year, what will you do? You will reverse deferred tax liability. How much value? Same. 50,000 ka 40%. How much is that? 20,000. Now check also if you want. First year, how much deferred tax liability you created? 40,000. How much did you reverse it in second year? 20,000. Take your calculator. You created 40 in first year. You reversed 20. How much is the balance? 40 minus 20 is how much? 20,000. Third year, again, how much you reversed? 20,000. So DTL balance at the end of third year will become 0. Why is it 0? Because after third year, is difference there or difference gone? Total depreciation for as per tax for 3 years is also 1.5 lakh. As per accounts is also, if you add, how much you're going to get? 1.5 lakh. So is difference there or difference has become 0? If difference has become 0, means DTA, DTR also should be reversed fully, which we have done. Yes, people? For this, they've asked journal entry. Can we go for the journal entry? Tell me, sir, what is the journal entry to create deferred tax liability? P&L account debit to deferred tax liability. How much are you creating? 40,000. Any problem? This is in first year. Second year, are you creating deferred tax liability or reversing? Reversing. So to create a liability, if you're confused, you can look at it like this. Liability will have what balance? Credit balance. So deferred tax liability is also liability. Now you have to create one liability, means you have to credit it or debit it. Credit it. What will you debit? P&L, because the remaining component is your P&L. So the journal entry to create deferred tax liability is P&L account debit to deferred tax liability. In the second year, are you creating or are you reversing? For creation, if this is the entry, means for reversal it will be DTL account debit to P&L. That's in the second year. For how much amount? 20,000. Third year, are you creating or reversing? Reversing. What is the entry? Deferred tax liability to P&L 20,000, 20,000. This is the journal entry for creating DTL and reversing DTL for the 3 years. Any doubt, everybody? So will you create only deferred tax liability or will you create provision for tax also? Provision for tax also. And how do you calculate? That only, in fact, if you remember AS 22, we used to call it as current tax. Current tax. How do you get current tax? Taxable profit multiplied by tax rate. If you do, you will get current tax. That current tax is nothing but your provision for tax. Yes, no, people? How do you calculate that? Take, how much is the profit before depreciation and tax? Before deducting depreciation and tax, how much is the profit? 2 lakh all the years is what they've said. Correct? This is profit before depreciation. Sir, for paying tax, will you consider accounts ka depreciation or tax ka depreciation? To pay tax, we need a taxable profit, and taxable profit you have to arrive expenses as per tax. That means you have to reduce depreciation here. But which depreciation? Accounts ka depreciation or tax ka? Tax ka. As per tax, what you will do? First year only you will take 1,50,000. Second and third year depreciation is how much? 0. That's what I've written here. Done. So from 2 lakh is taxable profit before depreciation. Reduce depreciation, you will get taxable profit. Any doubt? And how do you get current tax? Take taxable profit and multiply tax rate. How much is the tax rate they've given in the question, sir? 40%. So calculate 40% of these numbers. 50,000 ka 40% is how much? 20,000. 2 lakh ka 40% is how much? 80,000. 2 lakh ka 40% is how much? 80,000. Done. What is the journal entry for provision? You know this. What's the journal entry for provision for tax? For any provision, the journal entry is what? P&L account debit to provision. So instead of provision for tax, here we give a fancy name as what? Current tax. So what is the journal entry? Tell me, sir. First year, what you will pass? P&L account debit to current tax. How much? 20,000. How much is the provision for tax for second year? 80,000. So what is the entry? P&L account debit to current tax. How much value? 80,000. Third year, what is the current tax? 80,000. So the entry will be still P&L account debit to current tax 80,000, 80,000. That's all this question all about. Any doubt or okay? Similar question is available in our class notes also. Okay, but we have done a question on DTA, DTL ka reversal. Current tax entry may not be there, that they are added extra over here. Because journal entry you will pass for deferred tax also, you will pass the entry for current tax also. Both you need to give the entry. Any doubt, anybody till here? Just give you a time quickly, review that, ask me if you have any doubt. If you have got it, I'll move on to the next part of the question. One more part is there. It doesn't matter. Sir, we have done such questions also. If you open your notes there, one we had unamortized preliminary expense. Then we had got depreciation. The very first question in AS22, if you open, that is the very first question. One component gave you DTA, another component gave you DTL. We will not book both. We will always net off and pass. We have done such questions. Regular notes may if you open. So in fact, the very first question. Okay, you can open, you'll get it. Yes? Have I answered your question? Okay. Now listen everybody. Second case they've done a slight modification. In fact, that is the highlight of this problem. Till here, all this we have done. There's a repeat. Maybe a few things we have forgotten. That's okay, acceptable considering that this been really 4 or 5 months long. Fair enough, not a big deal. Second part is important. Pay attention to this first. Before that, maybe I get to the second part. There is another way to calculate DTL, which we'll have to use for second part. Can we try this? Everyone, pay attention. Take your calculator. Check everyone. Pay attention. Just keep the calculator and check the screen. No need to do anything else. This part is not relevant here. If I have written over here, no, this part. It's not required for this particular case. It's required for next case. But if you solve in this fashion, the next part will become more clear. So I want to put that point. Just check. In the first year, how much is the difference? Everyone, complete attention. How much is the difference in the first year? 1 lakh. Will you create DTL on the difference or taxable difference? Taxable difference. So you take the difference multiplied by tax rate. Take your calculator. 1 lakh of 40% is how much? 40,000. That means, can I say first year DTL, deferred tax liability balance is 40,000. DTL balance means where it will go? In balance sheet. This 40,000 will be shown as deferred tax liability in the liability side of balance sheet. Okay. Second year, everyone pay attention. How much is the difference? Plus minus 50,000. How much was the difference in the first year? 1 lakh. Now, how much difference they are saying? Minus 50,000. That means in 1 lakh, how much difference has got reversed? 1 lakh was the total difference. Everyone pay attention. 1 lakh was the total difference. In that, how much has got reversed? 50,000. That means how much difference is still there? In 1 lakh, everyone is getting this point? Pay attention to this one only. How much was the total difference? 1 lakh. In that, how much has got reversed in second year? 50,000. In 1 lakh, 50,000 has got reversed means how much difference still is there? 50,000. How did I get that 50,000? 1 lakh minus 50,000. Yes, sir. Sir, if 50,000 difference is still there means we have to create DTL. On the difference only we create DTL. So take that. And what is the tax rate? 40%. Calculate 50,000 ka 40%. How much is that? 20,000. Now means in the second year, pay attention, don't get deviated. In the second year, you will show DTL in balance sheet at what value? 20,000. Easy now. Yes, everybody. Check again. First year, how much was DTL balance? 40. Second year, how much you should show? 20. That means the DTL balance, are you increasing or reducing? From 40, it should become 20. That is the reason we said DTA should get reversed to the extent of 20,000. Getting comfortable, everybody? Okay. Third year, same parlance. How much was the difference in first year? 1 lakh. How much got reversed in second year? 50. How much got reversed in third year? 50. That means what is the difference? 0. Sir, if difference is 0 means DTL also should be 0. But till second year, what is DTL balance? 20. By the second year ka closing balance will become third year ka opening balance. What is the opening balance of DTL? 20,000. How much should be DTL by the end of third year? 0. That means third year you have to create DTL or reverse DTL? Reverse. How much? 20,000. This is another way to get the same answer. Why am I using this? Because you'll understand it better when you go for the next case. Understood, everybody? Pakka. Just to be on the safer side, can I build another case? You'll tell me the answer? Okay, same case. I'll just take another number just for my reference. Depreciation as per tax. Year 1, year 2, year 3. Hypothetical numbers I'll take, okay? Let's say depreciation is 3 lakh, okay, in tax. Second year and third year, 0. Depreciation as per accounts is, let's say, 1 lakh, 1 lakh and 1 lakh. So in tax, you claimed 100% depreciation in first year. In accounts, you're claiming it over 3 years. So is it matching or difference? So what is the difference? This you guide me. How much is the difference? 3 lakh minus 1 lakh is how much? 2 lakh. Here the difference is 0 minus 1 lakh, negative 1 lakh. 0 minus 1 lakh, negative 1 lakh. Any problem? Now, on the difference, will you create DTA, DTL or tax rate? Tax rate. Now, you tell me in this particular case, you have to create DTA or DTL? DTL. Why? Sir, expense as per tax is more. Expense as per tax is 3 lakh. Expense as per accounts is only 1 lakh. If expense as per tax is more means profit in the current year will be less. That means the tax paid in the current year also will be less. But tax payable in the future year will be more. If you have to pay more tax in the future, if you have a liability or obligation to pay more tax in the future means what will you create? Deferred tax liability. At what rate? We'll take the same rate. Let's assume the tax rate to be 40%. So calculate how much it will be. 2 lakh ka 40%, which is how much, sir? 80,000. Comfortable, everybody? Any problem or okay? Online also. One more scenario just to make sure that you have got it. I'm just bringing in the numbers. Done. Now we will use this approach and calculate DTL. Now, what was the difference in the first year? 2 lakh. How much difference has got reversed? In this, the total difference in first year was 2 lakh. In that, how much has got reversed? 1 lakh. So how much difference still is there? 1 lakh. If 1 lakh difference is still there means how do you get this 1 lakh? 2 lakh minus 1 lakh. Yes, sir. So how much difference is still there? 1 lakh. If difference is still there means should you have DTL? Yes. At what rate? 40%. That means how much DTL you should have? 40,000. Any problem? So that means in the second year, will you create a DTL or will you reverse DTL? In the first case, you will create or reverse? In the first year, you will create DTL for how much? 80,000. Second year, what to do? From 80,000 balance should become 40,000. From 80,000 DTL balance should become 40,000. So what you are doing? You have to create or reverse? Reverse. How much reverse? From 80 it has to become 40 means you will reverse how much? 40,000. Any problem? Like this. We will use this for next case study. So I want you to be comfortable with this. Understanding go? Okay, third year. How much was the difference in first year? 2 lakh. How much got reversed in second year? 1 lakh. How much got difference reversed in third year? So in 2 lakh both the 2 lakh have got reversed. So difference is how much? 2 lakh minus 1 lakh minus 1 lakh. That means the difference is how much? 0. 0 ka 40% is how much? 0. That means the DTL balance that should come in your balance sheet by the end of third year is how much? 0. DTL balance should come in your balance sheet at how much? 0. But what is the DTL balance currently? Second year ka closing balance will become third year ka opening. That means what is the opening balance of DTL? 40. But closing balance should be how much? 0. So from 40 it should become 0 means you have to create or reverse. How much reversal? 40,000. Understanding this, huh? Pakka. Online also comfortable with this scenario? Yes, unanimously? Confirm online? Yes. Now why am I saying this? This we do not use in our regular class. Why am I using this is, you will see the same question. Tax rate will not be same. Tax rate will change. Sir, if tax rate remains same, you can do it under normal method or this method, you will get the same answer. Now check the second case. I'll read. What will be the amount of deferred tax if substantively enacted tax rate for 22, 23, 24 is 40%, 35% and 38%? If tax rate changes, how you need to calculate? That is what we need to do. This new approach which I showed now becomes relevant for this second case. Understood, everybody? Remember the format? Yes? Okay, let's solve this now. This is the second case. Second case is what? Tax rate is same or multiple? We have multiple tax rate. So let's rework. The first is a separate case, second is a separate case. How many years still? 3 years. Now let's go back to the data. The same original data. How much is machinery ka cost? 1,50,000. How much depreciation did you claim as per tax? First year only you claimed 1,50,000. Second and third year how much? 0. But in accounts, are you claiming in first year only or over 3 years? So 1,50,000 is the cost of the asset. Salvage value is 0. Useful life is 3 years. So what is depreciation as per accounts every year, sir? 50,000. So is it matching or difference? Difference is there. What is the difference? 1 lakh, 50,000 negative, 50,000 negative. So far good. Everyone again pay the attention, check the screen. We will do it on the new approach now. Is the difference there? Yes. Again go back to the same step. As per tax, depreciation is 150, as per accounts it is only 50. That means depreciation as per tax is more. If depreciation as per tax is more means taxable profit will be less. Tax paid in the current year also will be less. But tax payable in future years will be more. Hence what will you create? Deferred tax liability. Correct, sir? Now this deferred tax liability, what is the closing balance? Tell me. Take 1 lakh and multiply 40%. We have 1 lakh difference. On that difference multiply tax rate, you're going to get 40,000. Any problem? So in first year, should we have to reverse a DTL or you have to create DTL? Create. Hence I have written DTL reversal is how much? 0. Because we are not reversing in first year, we are rather creating. Easy. Now come back to the second year. Pay attention. I'll give you time to update if you want. Listen. So depreciation as per tax is 0. As per accounts is how much? 50,000. That means the difference is there or difference got reversed. Now check. What was the difference in first year? 1 lakh. In that 1 lakh difference, how much difference got reversed? 50. How much difference still exists? In 1 lakh may 50,000 difference has got reversed means how much difference still exists? 1 lakh minus 50,000 which is 50,000. Correct? But now Josh may don't take 40%. For second year the tax rate has become 35%. That means you need to have DTL to the extent of 35%. Understanding? So for this particular approach becomes necessary. Understanding? If tax rate is same, you can follow old approach only, answer will not change. Even if you follow new approach also, you will get the same answer. But when tax rate changes, because you have to calculate DTL on what? Always the enacted tax rate. For second year, tax rate is not 40%, it has become 30%. Correct, people? So how much DTL should exist? In 1 lakh difference, if 50,000 has got reversed means difference still existing is how much? 50,000. On that 50,000, but take second year ka tax rate, which is how much? 35%. Do that, how much is it? 17,500. What is this 17,500? That is a DTL ka second year ka closing balance. This 17,500 should come as DTL in where? Balance sheet. Correct now? What was the balance in DTL in first year? 40,000. First year ka closing balance will become second year ka opening. How much DTL balance you currently have as opening? 40. But you need 40 or 17,500? 17,500. So in the second year you have to create or reverse. From 40 you have to make it 17,500. So you have to reverse. How much reversal? 40 minus 17,500. How much is that? 22,500 you will reverse. Entry you know. For creating DTL, the journal entry is P&L to deferred tax liability. For reversal, ulta. DTL to P&L. Calculation is the funda. Okay, Naji. Third year, again you tell me. What was the difference in first year? 1 lakh. In that, how much got reversed in second year? 50. How much got difference? How much got reversed in second year? Third year. Again, I'll tell you. How much was difference in first year? 1 lakh. How much got reversed in second year? 50. How much got reversed in third year? 50. That means is difference there or no difference? If difference is 0 means third year ka tax rate may be how much? Third year ka tax rate may be 80%, but difference is only how much? 0. 0 multiplied by 38% is how much, sir? 0. By the end of third year, DTL balance should become 0. Okay now? That means in your balance sheet, will DTL come in third year ka balance sheet or 0? 0. But what is second year ka closing balance of DTL? 17,500. Second year ka closing will become third year ka opening. From 17,500, it should become what? 0. That means you have to create or reverse. Reverse. How much reversal? 17,500. So first year creation, these 2 years reversal. Got it? This format will work when you have what? Multiple tax rate. When you have same tax rate also, you can use the same format. Answer will any which way be same. Done, people? Now this is the journal entry. What is the journal entry for first year DTL? P&L account debit to deferred tax liability, how much? 40,000. Second and third year you are creating or reversing? Reversing. What is the reversal entry? DTL to P&L, this is the value. That is it. So what about current tax? Current tax will change or only deferred tax? Deferred tax. Current tax is still same. 40, 80 and 80. That I have not copied. Fine now people? That is any which way same. Only DTA, DTL will change due to this particular adjustment. Understood this new format? Now I'll just quickly show it to you in case you want to take a snapshot or anything of this sort. Do it. This is an entirely new question. So this is the highlight of this RTP, I would say. Okay. We had not have any questions on multiple tax rate in AS22 so far. Now we got a multiple tax rate wala question. Understood? Need a minute or can I move on? Online also okay, G? Current tax, someone is saying it will change. No, sir. Why it will not change? How much is profit before depreciation? 2 lakh, 2 lakh, 2 lakh. You will reduce depreciation. Did depreciation change or same? Same. From profit before tax, if you reduce depreciation, from taxable profit before depreciation, if you reduce depreciation, what are you going to get? Taxable profit. Taxable profit multiplied by tax rate. And you mean to say rate of tax is changing, that's the reason it will change. Okay, that I understood. First year is saying, sir, you'll take first year the tax rate is 40%. Second year, how much is it? 35%. Third year it is 38%. Calculation is same, but here you will take 50,000 multiplied by 40%. Here you will take 2 lakh multiplied by how much is that? 35%. Correct. And here you will take how much, sir? 2 lakh multiplied by 38%. In that sense, it is right. Correct. Agreed. Manage. But they have not asked that. They only wanted to test this particular aspect. Done, Asaru? Okay. Can I move forward to the next question? Everybody? Okay. Now 17th and 18th are repetitive question. We have similar questions in our class notes. Concept is done. 19th is also a repetitive. Maybe 2 minutes may quickly I'll tell. This is an AS26 question. This is there in question, and this is question number 15 or something in our class notes. One extra adjustment they brought in. Maybe because of that I'll discuss. During the year, enterprise incurred cost to develop and produce a routine low risk computer software. Sir, are we purchasing software or are we developing? So it is what? Which concept? Internally generated intangible assets. Do you remember? Internally we are not purchasing, we are rather developing. Internally generated intangible assets are broadly classified into goodwill and others. Yes, others are also further classified into research phase and development phase. Research phase expenditure goes off to P&L. Development phase expenditure you will capitalize provided TRFRC is satisfied. We have discussed in AS26. That wala question this is. Okay, same question, similar one, except the last one extra pointer, same question with more or less same numbers are there in our class notes also. But anyways, we will quickly discuss this. Completion of detailed program. Sir, you are developing this particular software in many phases, from phase 1 to phase 7. At each phase, how much is the expenditure they have given? We need to figure out what we should do. That expenditure should be capitalized or whether it should go to P&L. So phase 1 is some design and all, you have spent how much? 25,000. Phase 2 may coding and testing for establishing technical feasibility. To establish feasibility, you incurred how much? 20,000. So feasibility is already established, or after incurring this it gets established? After incurring this 20,000, feasibility get established. That means indirectly I'm telling what? TRFRC will get satisfied after which phase? Phase number 2. Yes, sir, people. In fact, they've given also, check here. After completion of phase 2, it was established that the computer software is technically feasible for the market. What amount should be capitalized is what they're asking. That means TRFRC satisfied after which phase? Phase 2. Yes, no, people, correct, no? Before TIFRC, whatever expenditure you have incurred, all that expenditure will go off where? P&L account. Once the TIFRC gets satisfied, thereafter only you will start capitalization. So, other coding costs, phase 3, will you capitalize? Yes. Phase 4 cut testing, will you capitalize? Yes. Product masters for trading material, phase 5 expenditure, will you capitalize? Yes. So, these 3 is your development phase expenditure, which has already satisfied which condition? TRFRC. So, can you capitalize this? Yes. You'll capitalize this and show it as intangible asset or intangible assets under development. We have discussed this in regular class. Intangible asset is a separate category. Intangible assets under development is a separate category. Till the time development is happening, you will show this as what? Intangible assets under development. Now check. Duplication of computer software. Sir, when will you duplicate something? Once it is ready for use. Correct. Once it is ready for use, then only you think about duplication. That means after phase 5, asset is what? Asset is what? Ready for use. After the asset is ready for use, can you capitalize, or after that any expenditure to P&L? After this phase 5, whatever expenditure you incur, that goes off where? P&L account. So phase 6 ka some training material, whatever you have incurred, 40,000, that will be going off where, sir? P&L account. Packing of a product, even this expenditure also will go off to where? P&L. So these two if you add, you will get how much? 51,000. That 51,000 expenditure goes off where? P&L account. So basically only these three expenditure will be capitalized. Rest of the expenditure will go off to P&L account. In our class notes, this was not there. This duplication one, no, this was not there. Rest everything was there. Same words. Same words. If you flip open the notes, you will get this question. But you hope you got the concept. Duplication you will do only after the asset is ready. So that means phase 5, you could say that asset is substantially ready for use. So capitalization stops at phase 5. After phase 5, whatever expenditure you have incurred, that will be straight away transferred off to P&L account. Okay, Sarji. Excited? Last question for the day. Yeah. I am excited because I am tired today. Okay, I am trying my best to not nod off actually. I am feeling sleepy. Okay, yesterday whole night I couldn't sleep only. I don't know, from neck to back I had full pain. I couldn't sleep only yesterday. I slept in the chair only from 1 o'clock to 5 o'clock and did the session. I couldn't sleep. I was sleeping and I was getting backache. I don't know why. This is the first time I am experiencing this problem. Huh? Vaisaitala? I know. That's what first my thought was, that only. Yo, okay, no problem. Sir, you will go home and sleep now, sir. Royally will sleep today. Okay. Alright. AS29 ka question number 20, we shall take up the last question. They have given one big question, but concept is very, very simple. So let's see what we can learn from this particular question. During the year, QA Limited delivered manufactured products to customer K. So we manufactured one product and gave it to one customer called K. The products were faulty. That is Damar product. Okay. On 1st October 2023, customer K commenced legal action against the company claiming damages with respect to the losses due to the supply of faulty product. Since we supplied the damaged product, our customer filed a case against us, and directly now the case is going on in the court of law. Upon investigating the matter, QA Limited discovered that the products were faulty due to the defective raw material. We are manufacturers, no? So to manufacture, we need raw material. So we found out that the reason this finished product is faulty is not due to our manufacturing process. It is due to raw material which we purchased. From whom? Supplier F. So supplier F, no, it's like this. Supplier F. Supplier F gave us, he supplied us raw material. We are which company? QA Limited. Using this raw material, we finished or we produced finished goods and we gave it to which customer? Customer K. Now, since this product was faulty, customer K filed a legal case against us. On investigation, we found, QA Limited found that this faulty product is due to what? Faulty raw material. Hence, what did we do? Therefore, on 1st December 2023, company commenced legal action against F. Now, we filed case against F. Okay, this is what is happening. Alright. So, that means we have one case or two cases over here. Two cases. Customer filed one case against us demanding compensation. We have filed one case against the supplier demanding compensation. Great. The company, okay, fine. QA Limited has estimated that the probability of success in both the action of K against QA and action of QA against F is very high. So they are saying both ka success rate is high. Meaning indirectly they are saying customer will win the case against us and we will win the case against supplier F. So that means this is what, sir? So you remember provision? This is not reimbursement concept. Okay, so if your mind is saying reimbursement, no, this is a normal concept. Customer has filed a case against us. That means this is which case? Inflow scenario or outflow scenario? Outflow scenario. We have filed a case against supplier. If we win the case, we will get what? Outflow or inflow? Inflow. So one is what, sir? One is either a provision or a contingent liability. Another one is either an asset or a contingent asset. So we need to figure out what you will do. That's all is a theory question all about. They've given big drama, but we have to just tell whether it is provision, contingent liability or contingent asset. Can we go through the data fully? In fact, they've given a majority of the cases. Anyways, on 1st October 2023, QA Limited has estimated that the damages would we have to pay to K is 5 crore. We are saying to customer we have to pay how much damages? 5 crores. This estimate was revised to 5.2 crores at 31st March. 31st March is our year ending, no? And normally you make provision at what? Year ending. So how much is we should take 5 crores here or 5.2 crores? 5.2 crores because this is the year ending ka latest estimate. So how much is that? 5.2. And it became 5.25 in 15th May. 15th May comes in current year or next year? Next year. The case was eventually settled on 1st June. It's a typo. It should not be 22. It should be 24. When the company paid the damages of 5.3. So the estimate got revised to 15th May to 5.25 and later on final settlement happened for how much amount? 5.3. This is the drama, okay? Basically they're giving one amount. From 5 it became 5.2. Then from 5.2 it became 5.25. Then finally we settled for how much? 5.3. Okay, this is on 1st October, this is on 31st March, this is on 15th May and the last one was on 1st June. Now you tell me, sir, when will you prepare your accounts? 31st March. So which number is relevant for us? 5.2. Correct? Any problem? No. Okay, let's go further. On December 2023, that is, we filed a case against our raw material supplier. No, Q Limited had estimated that it would receive damages of how much? 3.5 crores from our supplier F. So we are thinking now we will receive on first. How much is that? On 1st December, maybe I'll write it in different ink. On 1st December, we thought we will receive how much? 3.5. This estimate from 3.5, it became 3.6 on which date? 31st December. And it became 3.7 on 15th May. Then this case was eventually settled for 3.75. So finally we received how much? 3.75 crores on which date? 1st June. So we have given various amounts. Again here, sir, we are preparing accounts on which date? 31st March. This should be 31st March, no? That means which number is relevant for us? 3.6. Correct? So this is a number relevant for us, looks like. Okay. Now look at the question. Stupid question. Q Limited had in its financial statement already provided. So the word provided means, when we use the word provided, it means provision. Okay, we have already made how much provision? 3.6 crores. Company has already made how much provision? 3.6 crores. But hang on, how much we have to pay? Should we have to pay 3.6 crores or looks like 5.2? 5.2. So looks like the number we had to make was for 5.2, but company has made provision only for how much? 3.6. In financial statements approved by the board of directors on 26th April. Oh, now they brought in killer. I mean, this question became like an AS 29 and AS 4 ka combination question. Yes, no, people. You remember what does this board of approval, which standard talks about this board of approval ka data? Accounting standard 4. What is that name? Contingencies and events occurring after balance sheet date. AS 4 talks about two events, adjusting and non-adjusting. If adjusting events are those events which occur between what? Balance sheet date. In fact, events means what? They are those events that occur between the balance sheet date and the date on which financial statements are approved by the board of directors. Your balance sheet date is 31st March. Board ka approval date is what? 26th April. Correct? No? So anything that occurs between this window becomes what, sir? Event. And this particular event is an adjusting event. This particular event is an adjusting event. Why? Because when did we file a case? Check, here only we wrote. We filed a case against the customer on which date? 1st October. That means we have to wait till March, and on October only we knew. On October only first case started. Second case started also in December. That means this is a new information. This is like a bouncer like our classes, or information was already there. Information was already existing. That means this is what sort of an event? Adjusting event. If it is an adjusting event, will you keep the provision as it is or adjust? Adjust. But hang on. Have they given 26th April ka any provision number? Check. They gave 1st October ka, they gave 31st March ka, they gave 15th May ka, they gave 1st June ka. But board of approval date is what? Board of approval date is 26th April. 26th April, do you know any provision amount? No. Suppose they had told 26th April, the estimate is 5.23 crores. What you would have done? Tell me. Since this is an adjusting event, you will adjust the provision and create provision for how much totally? 5.23 crores. Understanding? Because this is an adjusting event. Yes, sir, people? Correct? But do you know 26th April ka amount or missing? Missing. Since board of approval date ka amount is missing, we will take which amount? 31st March itself. All the other numbers becomes irrelevant. Yes, sir? Comfortable? Got it? So that means the number relevant for both inflow and outflow is what? 5.2 and 3.6. Easy. Now, 3 questions. Whether the company is required to make provision for claim from customer K. Sir, if you want to make provision means you have to go back to provision ka definition. AS 29 gives 4 definition of provision. What is that? Present obligation. Meaning that obligation should be there presently. Has customer already filed a case against us? Obligation means no escape scenario. Can we escape from this, or court will decide? So do we have present obligation? Yes. Arising due to past event. What is a past event here? We supplied to the customer faulty product. Has that already happened? Yes. Is it a past event? Yes. And there should be a probable outflow of economic resources. They only told in the problem. The chance of success is what? Very high. Very high means this is what? Possible or probable? Probable. That means the third one, obligation, is still probable. Fourth one is reliable estimate of the outflow. Here big estimate they gave, no. So number is missing or estimate is done. Estimate is done. So that means all the definition of provision is getting satisfied. So should we make provision? Yes. So that's the first answer. If yes, how much entry you will pass is what they're asking. How much provision will you make? 5.2 crore. What is the journal entry to make provision, sir? P&L account debit to provision for whatever you can claim. Provision for litigation, provision for claim, how much? How much is the amount we need to make it for? 5.2 crores. Done now. According to me, this entry is wrong. This is what entry RTP has given. According to me, this entry is wrong. Why? Can someone tell me why? Sir, will you pass the entry for 5.2 crore or some provision is already made? They have already made a provision of 5.2. That means again you will make 5.2 ka provision. No, you have already made a provision of how much? 3.6. From 3.6 you have to increase the provision and bring it to how much? 5.2. That means you need to pass the journal entry for whole amount or increase amount? Increase. How much is that amount? 1.6 crores. So you need to pass the same journal entry is same, but the amount should be how much, sir? 1.6 crores. That's what I've written my viewpoint over here. Okay, but that they have missed out, but that's okay, no problem. Let's forgive this ICA over here in this particular matter. Okay, no, but yes, one way they write is the total entry should be passed for how much amount? 5.2. But now we will not pass the entry for 5.2 because they've already made a provision of 3.6. From 3.6 increase it to 5.2. That means you have to increase provision by how much? 1.6 crores. This is with respect to what, sir? One case where there is an outflow. There is only one case or is an inflow case as well? We also filed a case against our supplier of raw material. That's a third question check. What will be the accounting treatment for action of QA Limited against supplier F? Supplier F is this guy who supplied us raw material. What you should do for that? Sir, they said what here? Success rate is very high. Sir, you know, you will book an asset. Sir, from supplier F, we have to pay money or it's an inflow? Inflow means there are only two possibilities, right? One, you will create an asset. In fact, I had given a chart also if you remember. If it is virtually certain, you will book on the asset side, asset. If the inflow is probable, then you will disclose contingent asset. If it is possible, then you will ignore. If you open AS29 card chart book and revision video, you will see this. If the inflow is remote, in that case also you will ignore. Here it is virtually certain or they said very high. Very high means what? It is probable. For probable inflow, for probable asset, will you create an asset or will you disclose contingent asset? That is what you need to write over here. Okay, it's not virtually certain. If it was virtually certain, you would have booked an asset. For what value? 3.6 crores. But it is not virtually certain here. It's only what, sir? Probability of winning is high. Okay, and it is not virtually certain. Hence, what you will do? You will disclose contingent asset. Don't get confused with reimbursement concept. This is not reimbursement concept. Reimbursement concept, what happens is there will be arrangement between these two parties. If Q pays customer means automatically Q will recover from supplier. In reimbursement, that will be the arrangement. They would have already entered agreement like that. Is it entered here or it's not? Sir, if agreement is entered, why will we file a case against supplier F? Correct, no? I mean, these are two separate cases. One is on the inflow side, another one is on the outflow side. This is not a reimbursement concept. Okay, so don't get confused with reimbursement and write off reimbursement provision. I know students will get confused here. That's the reason I wrote that also. Okay, people. Any doubts in this, people? Got it, people? So that's it with respect to this particular RTP session. Thank you so much for your time and patience. Take care.